Welcome to the Deep Dive. Our mission is to cut through the noise of earnings season and get right to the critical details you need to understand the market's biggest moves.
And today we are absolutely tearing into the Q3 fiscal 2026 results for Apogee Enterprises.
This was a classic high-stakes earnings call. I mean, the results themselves looked okay on the surface, but the forward outlook, it just triggered an immediate and, frankly, dramatic valuation reset.
That's exactly right. We're here to give you that shortcut to get past the management speak and pinpoint exactly why the stock fell off a cliff.
Separating the optimism from the harsh market reality.
Right. So let's start with the headline shock, because that really set the tone for the whole day.
Okay, so in Q3, adjusted earnings per share, they came in at $1.02.
Which was basically in line. The street was looking for what, $1.01 to $1.05, so that part was fine. No surprises there.
Right, so on the surface, you think, okay, business as usual. But the devil, as always, was in the top line and, more importantly, the guidance.
Net sales clocked in at $348.6 million. That was a miss. Consensus estimates were running a bit higher, somewhere between $355 and $360 million.
And when you pair even a small revenue miss with a massive guide down, that's when you get panic.
Oh, and panic they did. The reaction was just brutal. Before the market even opened, the stock was indicated down around 14%.
And when the regular session started, it plunged nearly 16.8% from the close.
And this wasn't on thin air. The volume just exploded 3 to 4 times the average. That's not just disappointment.
No, that's capitulation. That's the market saying we're out.
Exactly. A single-day drop of nearly 17% tells you the market believes management has completely lost control of the narrative. The worry wasn't about Q3. It was about everything they had to admit was coming next.
Okay, so let's unpack those Q3 sales a little more. Because that headline number, the $348.6 million, it was actually up slightly year over year, up 0.6%.
It was. And if you just looked at that one number in a vacuum, you might think, hey, the business is steady.
But that's where we really need to put the microscope on the core engine of APG, right?
Yes, because that 0.6% growth, it was completely misleading. I mean, it was basically a statistical illusion.
An illusion created by the recent acquisitions.
Exactly. Explain that weakness for us. If you strip out the impact of the companies they just bought, the core organic sales, the actual health of the business they already owned.
It was down.
It was down 3.3% year over year. The only reason net sales were positive at all was a 3.9% contribution from those acquisitions.
And isn't that just the ultimate red flag? I mean, without the life support from M&A, the core engine is actively shrinking.
It's a massive analytical point. And if your core sales are shrinking, your profitability is almost guaranteed to suffer.
And it did. We saw margin erosion across the board. Gross margin was down 60 basis points from last year to 23.8%.
60 basis points might not sound like a lot, but for every $100 in sales, they're making 60 cents less in gross profit than a year ago. That adds up.
And the adjusted EBITDA margin also dropped 60 basis points, down to 13.2%.
And that underlying pain was really concentrated in their bread and butter, the architectural segments, metals and glass.
Right. Management themselves basically admitted it. They said they're in a softening competitive architectural market. I think they called it
a classic late cycle construction tape.
Okay, for our listener, what does late cycle construction tape actually mean in plain English?
It means construction is cooling off, but more than that, it means pricing power is gone. Contractors know the market is soft, so they can squeeze suppliers like APG for lower prices just to win a bid.
So it becomes a race to the bottom. High volume, low margin.
You've got it. And you see that perfectly in the numbers. Architectural metals. Sales fell 9.9% year over year to $101.7 million.
Directly because of that lower volume and competitive pricing you just described.
And architectural glass was right there with it. Sales down 4.2% to $90.6 million, suffering from the exact same headaches.
To be fair, management did try to stress that the glass business is still resilient, that it's running in the high teens on EBITDA margin.
Which is historically strong for this point in the cycle, so credit where it's due, but the trend is undeniable.
Now we have to pause for the one major bright spot, which was really a home run for their M&A strategy.
Performance surfaces. Sales there surged almost 60%. $40.7 million.
And that was all driven by the UW Solutions acquisition they made about a year ago.
Yep. Management was glowing about that one. They confirmed it's on track to hit its $100 million sales target for the year and at a really attractive 20% adjusted EBITDA margin.
So that's the proof of concept for their strategy. It's just a much smaller piece of the overall pie compared to the troubled core.
A much smaller piece.
Okay, before we get to the main event, the guidance, we probably mentioned the management change.
Right. The CFO, Matt Osberg, left right before this report. Mark Agdahl, the chief accounting officer, stepped in as the interim.
And a CFO leaving right before a big negative surprise that often signals deeper issues.
It definitely raises an eyebrow about internal confidence, but honestly, I think the market barely noticed because they were so focused on the other shoe dropping.
The forward outlook.
The whole story was the outlook. The new CEO, who's been on the board since 2013, he quickly reaffirmed their strategy. Become an economic leader, use their Apogee management system.
Right, the AMS. Let's quickly define that for everyone. What is the Apogee management system?
It's basically their internal playbook for continuous improvement. It's their structured way of trying to drive efficiency, cut waste, and just run leaner and smarter across all their businesses.
And the market needs to see that playbook actually deliver when things get tough.
And that brings us to the shockwave, the guidance reset. This is the moment that 16.8% Plunge was born.
Just 2 months earlier, in October, they had reaffirmed their full-year guidance, adjusted EPS of $3.60 to $3.90.
And the new guidance, a brutal sharp cut down to just $3.40 to $3.50.
That is a huge delta. And what made it so painful was that they quantified the reasons. This wasn't just some vague commentary about a soft market.
No, they put specific dollar signs on the new problems.
Yeah, so let's break those down, starting with the biggest external shock, tariffs.
Yeah. The company said they expect tariffs, specifically on aluminum and coated materials from China, to reduce their full-year adjusted EPS by about 30 cents.
Just stop and think about that, 30 cents. That one single item is almost 8% of the bottom end of their old guidance range.
It's not trimming the hedges. It's chopping off a major branch of their profit tree. It forces a complete recalculation of their earnings power.
And the second hit was costs. The metal segment is just getting hammered by rising input prices.
We're talking aluminum prices up 13% just from Q2 to Q3, and up over 50% compared to the same quarter last year.
So that's compounding the problem. You have less demand and higher costs, squeezed from both ends.
It's a perfect storm. External cost inflation from tariffs and aluminum, plus internal demand softness that's leading to price wars.
The only way out of that is a major self-help strategy, which I guess brings us to Project Fortify Phase 2.
Exactly. They're expanding this cost-cutting plan, which is the right move, but it comes with a near-term cost that investors tend to hate.
They're increasing the expected pre-tax charges for the project to between $28 and $29 million.
And that's the trade-off. You take immediate earnings pain through restructuring charges, which is part of that guidance cut. But the goal is to get bigger savings down the road.
And the new estimated savings are higher right now, $25 to $26 million annually.
They are. But the critical detail here is the timing. Only about $10 million of that benefit is expected to land in fiscal 2027. So they're taking a big hit now to invest in next year's bottom line.
That setup for 2027 is crucial. The CFO gave some early hints about what to expect next year, even with those savings.
Right. They mentioned headwinds from incentive comp normalizing, because it was low this year since they missed targets, and higher health insurance costs.
But the big tailwind should be the non-repeat of that 30-cent tariff hit from this year.
That's the key. That should help offset those other internal cost increases. It's a clean setup, but it requires the market to look past the next 2 quarters of total chaos.
Which brings us to a huge contradiction. The new CEO is dealing with all this restructuring pain, but at the same time, he reaffirmed their commitment to M&A.
He didn't just reaffirm it, he said he wants to move faster with discipline on buying new companies.
That is a really bold thing to say when your core business is acting like a lead weight.
It is. It signals they're betting on diversifying the portfolio to drive returns, not just waiting for the construction cycle to save them.
Okay, let's put all this in context for an investor. APG stock has been a massive underperformer.
A 44.25% drop over the last year. I mean, that's just abysmal when you compare it to the sector ETF, the XHB, which has been basically flat.
The divergence is just striking. You have management talking about disciplined execution and cost actions, and the market just delivers the steepest drop in years.
It shows incredibly low credibility for the new guidance. The market is worried the architectural softness is even worse than they're letting on. The stock has basically taken a vote of no confidence.
So if you're an investor now, what do you need to see? What are the proof points?
We need 4 clear checkpoints. First, a stabilization of pricing pressure, especially in metals and glass. We need to see that the late cycle pain is bottoming out.
Second, we need clarity on the services backlog conversion. This was a super confusing point on the call.
It was. Management threw out a total backlog number of $775 million, which they said was up 4%.
But then other sources noted the actionable backlog, the projects they can actually convert to revenue soon, was $585 million, which is actually down over 11%.
And that's more than just ambiguity. That's failure to communicate. Which number do we trust? We need to see that conversion rate improve.
Okay, what are the third and fourth points?
Third, we need clearer tariff mitigation commentary. What are you actually doing to find new supply chains or pass these costs on? And fourth, we need tangible proof that those Fortify savings show up without more one-time charges bleeding into next year.
Okay, so the facts are a severe quantified guidance cut, a 16% drop on huge volume, and management pointing to quantifiable pain from tariffs and aluminum. It really looks like capitulation.
And that kind of volatility brings us to the segment where we think out loud about what it all means.
And disclaimer first, this is absolutely not financial advice. We are just reviewing the facts and building a hypothetical scenario. You have to do your own research.
Absolutely. The premise here is that the market may have violently overreacted. It aggressively priced in all the bad news, the 30-cent tariff hit, the restructuring, the aluminum pain, and dropped the stock from around $37 down to the low $32.
So the contrarian take is what?
The contrarian view is that management just created a quantifiable rebound story for fiscal 2027. You have the $25 to $26 million in Fortify savings, with $10 million of that hitting next year.
And you have the non-repeat of that massive 30-cent tariff hit.
Precisely. The bet is that the market has fully priced in the 2026 shock, but ignored the 2027 setup.
So how would you structure that idea?
Well, the outrageous but plausible idea is an opportunistic, maybe small, long position. You're aiming for a recovery of maybe half the loss, a retest of that $35 level. And you could make it contingent on seeing aluminum prices stabilize or hearing management talk up the M&A pipeline again.
And since the news caused options volatility to spike.
Exactly. You could buy the stock and sell calls against the position. It creates a defined, profitable exit if the stock just settles down and bounces back into a more rational range. It's an aggressive bet that the market's first reaction was an overreaction.
That brings us to our final takeaway. Q3 was flat, but the forward guidance, by putting a number on the pain, caused a massive valuation reset. The focus now is entirely on execution and delivering those Fortify cost savings.
But what really stands out to me is that contradiction. While they're performing major surgery on their core businesses, management doubled down on M&A. They said the pipeline is robust and they want to move faster.
So what does this all mean for you? The final provocative thought to leave you with is this. Given the complexity of this internal overhaul and the severe external headwinds, does the market really believe APG can successfully integrate new, high-growth businesses while simultaneously restructuring its core?
That is the incredibly difficult execution tightrope the new CEO is now walking. Thank you for joining us for this deep dive into the APG Enterprises earnings shock. We'll catch you on the next one.